Hello, everybody, and welcome back to the Last Honest Realtor. I am your host, David Fleming. Thank you so much for joining me today. I'm very excited to dive into this topic. And looking back at the podcasts that I've done, and again, I'm relatively new at this. I think we've done 7 or 8 of them. I haven't done anything that's considered salesy, and that's because I've been avoiding it. But at the same time, I feel like I'm leaving something on the table there. If I'm going to give people advice on what they should do, and many people doing podcasts, they don't really want to do that. They don't want to stick their necks out. But I really do believe that now is the time for people to consider buying a 1-bedroom condo for investment. So why am I not explaining why? Why am I not telling people all of the reasons why the market is perfect for this right now? Well, I'm going to do it today. So I can't answer why I haven't done it. But we are on the eve of an interest rate announcement by the Bank of Canada. This comes out on Friday. We decided to record this on Tuesday. I always like doing things ahead of time because I like to look back and see if my predictions were correct. Now, I believe, as does the street, as do all of the markets, and as do 14 economists out of 14 polled by the Wall Street Journal this week, that we're going to see an interest rate cut. Now, that is not the only reason why I think that it is time to buy a 1-bedroom investment condo in Toronto. In fact, I have 7 reasons, 7 that I have jotted down, and I'm going to go through them one at a time. But before I start, I'm going to say this. Putting my money where my mouth is, I am going tomorrow with Tara. She's sort of my, look into the rental market, and I don't know. I like a second opinion and company. I'm going tomorrow with Tara to look at a property that I think is a fantastic opportunity. And again, I'm not trying to come off as salesy, but it's a great opportunity for me. And as I will mention, I had dinner, wings, with a friend of mine last night who's my investment advisor, who was sort of telling me for years, look, you've got a lot of exposure to real estate, you work in real estate, invest in, private mortgages. Maybe you need to pull back a bit. No, we talked last night and even he said, yeah, I agree with all of your data points. So let me get right into it. Smart money buys ahead of the market incline and not during. That's my first point today that I want to talk about. Now, easier said than done, of course. If you have the benefit of hindsight, you can always look at a curve and say, oh, right, here's where it starts to go up. Well, I want to buy right there. We don't have the benefit of hindsight, but I want you to try to picture a chart. And this is that sort of falling knife analogy, and I've always used this. Picture a chart, and whether it's a stock or let's just say it's, a widget, picture a downward curve. And let's say that this item was at 100, and it goes down to 90, and it goes down to 80, and it goes down to 70. Now, on the way down, people are probably unlikely to buy this at 70, right? They're afraid it's going to go to 60 and to 50 and down to 0. But let's say that somebody says, no, I'm not going to buy it at 70, and maybe it goes down to 65, they feel better. Then it goes back up to 70, and to 75, and to 80. That's where people buy. People like to buy on the way up, and who could blame them? Of course. That's just basic investor psychology. So again, if you're a visual thinker, you probably understood what I was just talking about. If you're not a visual thinker, well, I'm going to have to talk about this again. Something is priced at $100, goes down to 70, or in our case, 65. But I'm telling you, you should have bought it at 70. When are you going to buy it? You're going to buy it on the way back up at 80 or 85, or maybe even 90. Because of course, hey, well, the previous peak was 100. We're going to surpass that. But the point is, with the benefit of hindsight, sure, you could have bought the thing at 70 instead of 80 or 85. But most people don't like to buy on the way down. The smart money does. The smart money buys on the way down, not afraid of a further drop. So in our example, the person who says, yeah, I'll buy it at 70, they're not afraid of it going to 65 or to 60. Maybe they buy again and dollar cost average because they're certain that it's going to go back up. Now, of course, people will say, how do you know it's going to go back up? There are shares of stock that could go to 0. Companies could go bankrupt. You can't just say that you're going to buy a share of stock and you expect it to go back up. Real estate is a different animal. Real estate has always recovered in the city of Toronto, which I'll get into for one of the other points. But whether or not you are bullish or bearish about the price of Toronto real estate, every single market peak has been recovered as we look back at the last, say, 30 years or so. So I believe that the smart money buys ahead of the market incline and not during. And I believe that right now, as I will explain in one of my other points, we are at that bottom of the trough for the Toronto condo market. Could we get a little bit lower? Sure. All things considered on a relative basis. Could that trough happen 6 months or 9 months from now? I don't think it's going to. But if it does, we are talking, of course, about a long-term investment, and that is one of my other points. Now, the second point I want to make, and this is Probably the most boring point because people talk about it all the time, but interest rate cuts are coming. Now, we went from a 0.25% Bank of Canada lending rate all the way up to 5%. 475 basis point increase from the bottom to the top. We've seen one cut in June. It brought us down to 4.75. We're going to see another cut tomorrow that brings us down to 4.5. So it's only 50 basis points. We went up 475. But the point is, whether you have a background in economics, whether you're a layman, quantitative easing, I was trying to shame other people for not knowing it and then I mispronounced. Quantitative tightening, quantitative easing, they come together all at once and there is no sort of mixing. So if we were in a cycle of quantitative tightening, that's where you see 11 straight rate increases very quickly, which of course has never happened in the history of our country. Quantitative easing is going the other direction. What we don't see is, oh no, we've made 2 rate cuts. Let's change course and then increase rates 3 times. You are either in a cycle of quantitative easing or you're in a cycle of quantitative tightening. Right now, we are in a cycle of quantitative easing. We saw 11 straight rate cuts, increases. I don't think we're going to see 11 straight cuts. That was the point I was trying to make. But I do believe that we are going to see 5 to 8, roughly. So whether or not we get back down to something palatable, and that happens by the end of this year or next year, is not the point I'm trying to make. The point is just simply that we are in this economic cycle. And when you look historically at economic cycles, whether it is quantitative easing or quantitative tightening, the market usually responds in kind. As such, 2022, 2023, we saw quantitative tightening. We saw Bank of Canada standing up and saying, we need to get inflation under control. We are going to do that. We are going to raise rates. We're going to do it at an unprecedented rate. And of course, the market responded. Toronto wasn't hit that bad, let's be honest. But the rest of the country, some of the areas outside of Toronto and the GTA and the outskirts, yes, they were hit pretty hard. Now the flip side is happening. And it's very hard to argue that if we're going to see a cycle by the Bank of Canada, and just basically for the good of the entire economy, of quantitative easing, it's very hard to argue that we're not going to see real estate prices increase, especially in the segment that has been hit the hardest, which is one of my other points. So the headlines today. CTV News says, 2/3 of Canadians polled say they desperately need interest rates to go down. Global News says, a big green light to cut. What to expect from the Bank of Canada this week. The Wall Street Journal says, Bank of Canada looks set to deliver back-to-back rate cuts. And then underneath it, it says, which I had mentioned at the onset, all 14 economists surveyed predict the main interest rate will fall to 4.5% with more rate cuts through 2025 on a weaker outlook. That is correct. The economy itself, not doing exceptionally well right now, and unemployment might be something to consider. The June unemployment number in the USA was 4.1%. The June unemployment number in Canada was 6.4%. This simply cannot continue. And the trend, I'm going to go to my computer here, the unemployment rate in Canada is something that to me just doesn't look good. We went from 6.2% last month to 6.4. Previously, we were at 6.1. Before that, 5.8, 5.7. And if you want to go back to, let's say, this time last year, we're at 5.4%. Now, you might say, oh, well, okay, from 5.4 to 6.4, we're splitting hairs. What's the population of the country? Yeah, okay, 35, 40 million. What's 1% of that? You cannot have unemployment go from 5.4 to 6.4 inside of a year because that's what, 350 to 400,000 more people that are out of work. The Bank of Canada has no choice but to start quantitative easing, and we are going to see rate cuts. So unemployment is just one statistic. The other, of course, is inflation. Now, inflation was 2.7% in June. This was down from 2.9% in May when everyone freaked out and said, oh no, inflation, it's going up. Right, it went from 2.7 in April to 2.9 in May, back to 2.7 in June. But we're coming off of a peak of 8.1% in June of 2022. Right, of course, that was the peak, and we had already seen the Bank of Canada before then start to increase rates. So sometimes the stats will lag the actions, of course, and I do believe, in this case, that we are still going to see a further decline in that inflation number. So any economist says you want to keep inflation at 2%. I wouldn't say we're splitting hairs between 2 and 2.7, but I would say certainly as we see the number decline to 2.5 and to 2.4, we're right where we need to be. So inflation under control, unemployment not. Rate cuts are coming, and they are coming in waves, they are coming in droves. So again, my second point, rate cuts, goes hand in hand with the first point. Smart money buys ahead of the market incline. And I do believe the market will be inclining, not only because of the decrease in prices of late, but because as money becomes cheaper, more people will jump in. Now, I mentioned a friend that I had dinner with. We actually just went to Duff's Wings because that's what I want to do. I don't want to go anywhere fancy, just give me some wings, damn it. And my friend works in financial services, and no, he's not, Bob, the over-the-counter, guy at the bank. Somebody that's very high up in financial services. Of course, everyone else would say this about their friend. I trust him. He knows what he's talking about. But even he, who is telling me, hey, real estate, yeah, well, there's friction costs. There's, of course, the risk when you're renting it out, and, do you have the time to manage that sort of thing? And you've got exposure to real estate because you work in the business. Even he is someone that is saying, yes, there are 5 to 9 rate cuts ahead. That's what he told me, 5 to 9. I said 5 to 7, 5 to 8. And even he said, yes, I do expect that at this time next year, and again, he's not in real estate, but he said, I expect that this time next year, we'll see a huge run up, basically from what? Jan, Feb through to April, May, June. So this time next year, you'll be able to tell me you were either right or you were either wrong. Right now, just continue to listen. Keep an open mind. Again, I'm not trying to be salesy. I'm just telling you what I really, truly, firmly believe. So my third point is this. As I said, I don't want to be salesy. All markets recover. They do, right? All markets recover. Now, all markets, not all individual stocks. I mentioned, of course, you could have a stock that's trading at $100. There's an underlying company there. That company could go bankrupt. That stock could go to 90, 80, 70, 60, and all the way down to zero. All markets recover. Economic cycles, they're called cycles because, of course, they go up, they go down, right? They go good, they go bad. And this market is going to recover as previous markets have recovered. So let me give you a couple of data points. People talk about 2008, the huge financial crisis that happened all across the world. And as history has shown, and as I've discussed in other podcasts, the Toronto real estate market, it wasn't immune, but it really wasn't hit in the way that the real estate market in the United States was. And that is thanks to our very safe banking industry, which you can hear about in another podcast. But in 2008, I'm going to throw numbers at you. So you're going to have to pay attention here. In 2008, our peak came in April. That was $398,000 and change. Average home price, $398,000. I have to specify that because some people with the average home price at about $1.2 million can't possibly fathom that the average home price was a third of that. So we hit a trough in October, which again, there's some seasonality there, but the market went down on average 11.4%. So take that for what it is. Is that the worldwide financial crisis? Is that simply seasonality? But it only took until June of 2009 to surpass that peak again, when we saw the average home price at about $404,000. So in review, 2008, we peaked at about $398,000 change in April, and then we re-peaked only 14 months later, in June of 2009. Now, 2017 was more pronounced. Our peak was about 920,000 in April. We hit a trough of 732,000 in August. Now, again, cyclicality, the market's depressed in August, but that represents a 20% decline. So without seasonality, say it's a 15% decline. And it took 3 years and 2 months to recover. This was June of 2020. So in 08, it takes a year and 2 months. In 17, it takes 3 years and 2 months. Now that brings us to our peak in 2022. And again, we have to consider a lot of people have said this would not have happened without the ultra low interest rates. Absolutely. I agree. We still would have hit a peak. It just wouldn't have been as high. Now that peak, average home price in February of 2022, was $1,334,000 and change. The trough, $1,038,000 in January of 2023, but we're now back up to $1,162,000. So whether that was, of course, an overreaction to the market decline, whether, of course, that was seasonality being in January, regardless, I think it's fair to say a lot of houses and condos in the GTA declined in price. Some of them were paper losses. Some of them were realized losses. Now, some of them were more than average. Some of them were less than average. And I've made this point on my blog over and over. If the average home price declines by 20%, that doesn't necessarily mean you would sell your house for 20% less today. Of course, in some areas, you could sell your house for 30% less today. It really depends on where. And I've always maintained that the central core of the 416 is, of course, a little bit more immune to, say, some overbuilt, over-speculated subdivision that's north of whatever the northernmost boundary is of Markham, okay? Where's the north boundary of Markham? It's right here. And then on the other side of that, we're making a subdivision. We're extending, we're extending the city of Markham, basically. And yeah, well, you were speccing on this, and now you're burned to the tune of 35%, and the market average is down 20. Point is, an average is made of smaller averages. And I do believe that that decline down to 1,162,000 is a little bit more pronounced outside of the central core. So all markets recover. That's my third point. Second point, rate cuts are on the way. First point, smart money buys ahead of the market incline. My fourth point is probably the most important. And it's one that to me comes with some vindication and some sorrow, because it has to do with the pre-construction condominium industry. Now, I did previously a podcast on the pre-construction condominium industry. I've been writing about this on Toronto Realty blog basically since I started the blog in 2007. And my first bullet point here is history lesson. Yes, of course. So per the blog post that I did and the podcast that I did very recently, I'll give you a very basic history lesson, which is this. Once upon a time, it costs you less to buy pre-construction than resale. And that made perfect sense. Absolutely perfect sense. Fast forward today, the pre-construction prices are absolutely astronomical and they make 0 sense. Now, why is this important to you? First of all, I've never sold a pre-construction condo. Ever, and I never will, because all of the reasons included in that podcast, which you should listen to, which we don't have time to delve into, but also because I'm sitting here right now and I'm kind of saying like, okay, well, I wasn't exactly wrong. Why would you pay more for something that has more risk? Why would you pay more for something that's illiquid? Why would you pay more for something that comes with a higher down payment? Why would you pay more for something that comes with all kinds of hidden costs, such as the HST that, yes, you will get back 9 months after closing, but from a cash flow perspective, no problem shelling that out. Of course, the development charges and all the other levies. So many risks, no reward, in my honest opinion. Now, again, I go back to 04, 05, 06. If a resale condo is trading for $250 a foot, you're buying pre-con for $200. Makes perfect sense. Somewhere along the way, those prices drew even. And shortly thereafter, pre-con started to cost more. And that's where we are today. Pre-con is so insanely expensive that resale, in some cases, you're like a 40% discount. That can't continue. That cannot continue. And again, I'm talking about buying a one-bedroom condo in the downtown core for investment. I'm not talking about selling it in a year. I'm talking about the longer term. Whether that's only 3 to 5 years for you or whether that's 10, my thesis is this. Just as the pendulum swings left, it swings right. And just as we used to see pre-con prices lower than resale, we've seen pre-con prices so stupid up to $2,000 a foot, or that was what they were trying to sell for, in a Freed project that I wrote a blog about earlier this year. I do believe the pendulum will swing back the other way, where we will see that gap shrink. Now, that either means that pre-con prices are going to come down or that resale prices will draw even. But here's the rub, guys. Pre-con prices can't come down because it's costing developers right now $1,000 a foot, $1,100 a foot, in some cases $1,200 a foot, just to get off the ground. So let's say that it's $1,000 a foot. Let's say that a builder can build for $1,000 a foot. If you're going in and buying in a 12-year-old building for $800 a foot, you're buying for less than the cost to build. I could just end the podcast right here. Is that not reason enough to make my point? So in the market right now for pre-con, well, there is no market for pre-con. Nothing's selling, no one's launching, and there are no sales. Let me come back to that. In the market for pre-con, we are seeing people trying to flip assignments. Now, an assignment, for those that don't know, you've bought a pre-construction condo And for whatever reason, you've decided you don't want to close on it. Maybe it's because you think you've made enough money. That did happen, 10, 12 years ago. Or maybe it's because you're absolutely bleeding money and you simply cannot close. So what do? You look to assign your agreement of purchase and sale. That market right now is completely and utterly dead. And even if you were to walk away from your 20% down, in some cases, you still can't unload your ridiculously overpriced assignment. Mull that over for a sec and take a quick break. I'll be right back. Welcome back. And just before we broke there, I was talking about condo assignments. And the reason I bring these up is not to talk about necessarily how weak the condo market is and how bad things are, and that might completely contradict the fact that I'm talking today about why the time is right to buy a one-bedroom investment property. But rather, I have this thesis that I have mentioned, which is that the cost of pre-construction condos has gotten so high that it just doesn't make any sense. Now, I could speak forever on this. The fact that our entire downtown core has been financed by mom and pop investors, individual investors. They go and they pay ridiculous prices for pre-construction condos, ridiculous in my opinion, that 5 to 6 years from now seem less ridiculous because prices have caught up, but I would have long maintained you could have done better on the resale side. Now that is how our condominium boom has been financed. As I will mention shortly, when you take investors out of the equation, it leaves a lot of uncertainty about what the future holds. And that's another good point for why I think there'll be a huge deficit in condos in 3 to 5 years. But if you look at some of these condo assignments right now, it shows you that there's weakness, but there's more weakness and more opportunity in the resale side. Not only that, when you look at some of these pre-con prices, it's going to be really hard in a moment when I show you an example of a resale unit I'm looking at to suggest that, oh, you know what, David? I don't think that's a good deal. So thankfully, I get spam email from people trying to flip assignments. And I have this email today. It's called Assignment Plus. And the timing was absolutely perfect because I got to go through and look at some of these assignments. So how about this? A building called GAC Condos. They are offering a 566 square foot condo. Again, it's not a condo, it's an assignment. Who knows if this thing is actually in occupancy or if there's a gas station on the site. They haven't broken ground. A 566 square foot unit for $699,900. Now that's $1,236 a square. But, and here's what's happening in the assignment market, because people want out, because they either don't have the money for a further deposit, they don't have the money to close, they can't get financing to close, people are willing to take a loss. This unit that's up for $699,900 was originally bought for $756, meaning this person paid a whopping $1,336 per square foot in pre-construction for a building on Jarvis. Now, 28 Eastern condos. This is crazy to me. A 919 square foot unit, an attempted assignment for $1,427,500. That is, ready for this, $1,553 per square foot. Now, on an absolute basis, you look at $1,427,500, you could buy a killer 3-bed, 4-bath renode in Danforth Village, or you could buy a 919 square foot assignment. Yeah. Now, how about Maverick condos? There's one up right now for $970,000. It's a 708 square foot condo. This is an assignment. That's $1,370 a foot. But if you look at their original purchase price, $1,121,250 or $1,584 per square foot. Now consider that this person is trying to sell this and lose $150,000. They paid $1,121,000. They're trying to assign it for $970,000. They're saying, I will walk away from $150,000. Now, why? Probably because there's closing costs, there's a loss on the unit, Or maybe they just don't have the money to close. Not your problem. And the last one I'm going to show you here, guys, this one's a real doozy. God, there's so many of these. You don't know how hard it was to choose. $600,000. $598. $990. But let's say $600,000. $600,000 for a 427 square foot studio at 199 Church Street. That's 1,402 a square foot. But these people originally paid $694, which means that they paid $1,625 per square foot. Guys, I've never sold a pre-construction condo ever. So on the one hand, you could say, real estate's overpriced, the whole market sucks, all these people are losing money. David, why are you telling me to go in and buy a condo when you just gave me 4 examples of people who are losing money? Well, as I just mentioned, I've never sold a pre-construction condo for exactly this reason. The math has never made sense. Who buys them? I don't know, guys. These 4 people, they're going to lose a lot of money. And I was telling my team earlier today, over the next few years, the loss is going to be absorbed in order to get these condos built. Now, the developer, they're not going to absorb the loss. A buyer, as in a new buyer, they're not going to absorb the loss. Who's going to absorb the loss? Well, the original pre-construction investor. And I should put investor in quotes because a lot of these people, look, you're late to the game. Had you been buying pre-con in 2004 or 2010, yes, you would have been doing very well. But for the person that paid $1,625 per square foot at 199 Church, and I would estimate that that was somewhere between 2018 and 2021, what the hell were you thinking? What the hell were you thinking? $1,625 a foot. And that doesn't even include the occupancy phase where you're going to be paying money every single month in your phantom mortgage. That doesn't include the development charges and levies. That doesn't include the HST nightmare. $1,625 a foot. So while some of you might be thinking, David, you just told us about these people losing money. You just told us about the astronomical prices. How in the world are you going to make the argument that now is the time to walk in and buy a 1-bedroom condo for investment? Just keep listening. Because at the very end, I'm going to give you an example of a unit that's on the market right now. And it's less than $800 a foot and it's done. Or you could buy this pre-con for $1,625 a foot. No, you don't want to? Good, you're with me. So as there are no new condo launches right now, and as there are no sales, because there have been a couple launches, literally a handful of sales, because who's paying $2,000 a foot for one of Freed's units? It makes me think that if we literally do not sell and do not launch anything this year, and maybe that goes into next year, think about condo starts, think about condo completions, or let's just say housing starts and housing completions. If you were to have an 18-month period where there were no starts, it takes an average of what, 4 years to finish something? Does that not mean that 4 years from now, we're going to have a massive deficit? Sure. We cannot build fast enough to satisfy the demand. And not just demand from investors. I'm talking about the necessity. I'm talking about immigration at record high levels. And I am talking about the fact that we have to have somewhere for these people to live. Now, in the context of supply and demand, obviously, if there's not enough housing for people, then prices are going to go up. Say what you want about the market right now. Say what you want about the next 3, 6, 9, 12 months. The point I'm making is that when you forecast out 4 to 5 years, number one, with the cuts, we're going to have more people buying. It'll push prices up. Number 2, we just saw a big drop. We're going to recover that. Number 3, all markets recover. Okay, that's another point that's going to make the market push up. But as we are seeing no launches and no sales and no starts in pre-con, I really think 3 to 5 years from now, there's going to be a ridiculous deficit. So I want to move on to my 5th point, because so much of what I'm talking about in this pre-construction versus resale, my 4th point, and the fact that there are no sales, there are no launches, that's going to play into the next couple of points. Point number 5, the condo market has been hit so hard. Now, I'm a stats person, and this week, probably because I haven't written it yet, I would like to look at the absorption rate in the condominium market. Now, the absorption rate is simply a ratio of sales to new listings. Now, if you have 100 new listings and you have 40 sales, right, 40% absorption rate or sales to new listings. Of course, it's not 40 of those 100. It's just new listings in that month and sales, because those sales could have been from a previous month. So when you look at the 416, the condo market absorption rate, I want to give you some background. For the year, 2018, absorption rates 65%. 2019, absorption rates 66%. 2021, we skipped 2020 because of the pandemic. 2021, the absorption rate is 70%. 2022, absorption rate's 49%. Now, specifically in 2022, January we're at 80%, February we're at 70%, March we're at 63%. Remember what happens? The market drops, rates are going to be increased, the government tells us they're going to crush prices, and then you start to see that absorption rate decline. 47% in April, 37% in May, onward. That's why we finished the year at 49%. Now in 2023, 42%. 42% in 2023. That's less than the 50% mark where we say, in theory, an absorption rate of less than 50% becomes a buyer's market. But so far in 2024, the absorption rate is 34.3%. And the crazy thing is, we started the year at 39.5%. February was 40%. March was 41%. Then we saw it start to drop off. 33.6% in April, 31.4% in May. In the month of June, 26.5%, which for all of the months that I'm looking at is the second lowest absorption rate. Only the 24.5% recorded in September of 2023 was lower than the 26.5% absorption rate we just saw. This is not going to last. Again, for the people that are afraid, and of course, we could write a whole blog or do a whole podcast on the inherent risk involved with investing. And to get a reward, you need to take a risk. I understand people are afraid of the market getting worse or the market dropping more, but this is not going to last. A 26.5% absorption rate? No. It's the second lowest out of, we have 6 years times 12 months, okay, 72 months, and it's the second lowest on there. That tells me that this is the time to buy. You buy when the market is bad, not on the way back up. Now, most people, only what? 99% of mom and pop investors will buy on the way back up because it's comfortable and it's nice and it feels good and you're not as worried. Think of what I said at the onset. A stock is at 100, then 90, then 80. And at 70, you should jump in. But you're afraid it's going to go lower and it goes to 65. But then it goes right back up to 70 and to 75 and to 80. And then you finally buy it at 85 on the way back up. You could have bought it for 70. But no one wants to do that. No one wants to buy on the way down because it's scary. And right now, in the condo market, the 416, that 26.5% absorption rate is where we're seeing, right, it's really scary. What if it gets worse? But the point I want to make in point number 6 here, long-term is not 2 months. That's all you need to know to take away that fear. If you can't afford it, and the idea of, oh no, if I was cash flow negative, $500 a month for 12 months is going to break me, don't invest, ever. Okay? You don't have it. I'm talking about people that can withstand a little bit of pain and a little bit of loss for a ridiculous return in the medium and long term. Today's weakness will not last forever. Now, condos are not shares of stock that could go to zero. We know that. And all markets recover. We know that. But just think of the replacement cost. Think of the idea that a developer has to charge $2,000 a foot right now. And again, I am not looking at the balance sheets and the financial prospectus of some of these developers. But when Peter Fried started looking at $2,000 a foot for that new development that I talked about on my blog, it wasn't because they were building for $1,000 a foot and they just, really wanted to make a ridiculous profit. The cost of the land plus the cost of all of the rezoning and all of your architecture and all of the stuff that happens before you ever get a shovel in the ground and working with the municipality and all that ridiculousness. I won't say ridiculousness, but I think it's fair to say it's pretty difficult to build the city of Toronto. But once you get to that point, and then you have to talk about the cost of labor and the cost of materials and just everything else that goes into it, All of this stuff has skyrocketed in price. And Toronto's not a city of parking lots anymore. Because I work on land assemblies on the side, and I can tell you that, when you look at, and I'll use this as an example, years ago, there was a lady that, she owned a house on a main street. And she said that her and her neighbors all wanted to package and sell to a developer. But with what they all wanted, and not just wanted, what they really needed, let's say your house is worth 1.4, you're like, well, with the cost of real estate fees and land transfer tax and where am I going to go, it doesn't make sense to do it for less than 1.6, 7. So my house is worth 1.4, I want 1.9. When you added up the value of the 9 houses, and I went and took that to a developer who's going to buy this, tear them down, and what? Build a bunch of townhouses? Absolutely impossible. And basically what that developer said was, I would have to buy all of these people's houses for half of fair market value just to break even on the cost to develop. Now, of course, the lady I was speaking to, she didn't believe me, spent another couple of years spinning her wheels, trying to sell this thing. But the cost of land is so expensive because when you are buying a whole bunch of existing properties to tear them down, or in some cases, developers are buying a 20-story building because they can tear it down and build an 80-story condo. It's too expensive to build. So belabored that point, my apologies. It's so expensive to build. And so if it's going to cost $1,000 or $1,100 to build, how can we balk at paying $750 a foot for a resale condo in an extremely distressed market with an extremely distressed seller? Whew, that's a doozy. Let me take a quick break, guys, and I'll come right back. Welcome back. I talked to you about the market declining. I talked to you about the ridiculous prices being paid and now trying to be assigned in the pre-construction market. What I haven't done is given you a real example of what I'm talking about, so let's do that right now. There is a unit for sale on Richmond Street East in the St. Lawrence market area. Now, I lived at King and Sherbourne for many years at 230 King Street, and I always said King Street gets an A, Adelaide gets a B, and Richmond gets a C. So right off the bat, the location's not incredible, but this is a building that is 13 years old. This is a building that is, let's say, a 12-minute walk to Yonge Street, a 15-minute walk to the financial district. It's a building with reasonable maintenance fees, a good amount of money in the reserve fund, all of the things that you look for in an investment. There is a unit up for sale right now for $499,900. That's a 575 square foot condo. So let's just do the math there. I apologize, I'm actually gonna type this in. $499,900 divided by 575, folks, that's $869 a square foot. So just think about it. I was talking to you about these assignments where people are looking for $1,300 or $1,400 or $1,500 because they paid $1,400 or $1,500 or $1,600. Why is a resale unit available for $869 a foot? Is there something wrong with it? No, there isn't. And I'm going to look at the photos. You can't see what I'm doing if you're watching on YouTube or listening on Spotify or wherever you get your podcasts. But I'm looking at this unit and I think, okay, it's got a 9-foot ceiling. It's got a decent view outside. The kitchen, it's granite, it's stainless steel. Light fixtures are nice. There's a big bedroom. Has a real living room and a real dining room. This is a 575 square foot condo. They're at $499. Guys, consider the one that I mentioned at 199 Church. That's an assignment. They're looking for $600,000 for 427 square feet. Someone paid almost $700,000 in pre-construction for 427 square feet. Why is this thing available for $499,900? Well, sadly, because some people need to sell. And that's true of any market. If you're in this market right now and you're listening to this and you own a condo and you're like, oh no, guys, you're not selling right now. You don't have to sell. But in any market, there are opportunities created by, well, pain points. And who knows why these people need to sell. But the most important part about this is that they paid $575 for the unit 4 years ago. Maybe I could have led with that. They paid $575 for this condo 4 years ago, and now it's in the market for $499,900. But there's more. It's been on the market for a month. It's now sitting empty. There was a tenant that left at the end of June. So I'm going to make the assumption that they're flexible on that price. Anytime you see a listing, a month on the market, they have to be flexible. So $499.9, would they take $495? Yeah. Would they take $490? Of course. Would they take $480? I don't see why not, because it's clear that it's not moving. So could you drop another $5,000, $475, just to say that you got it for $100,000 less than someone else paid for it? Maybe you could. That's what I'm looking at in the downtown market right now. And we actually did a pick 5 on this, which will be out on Thursday. Well, yesterday if you're listening to this now. And that was my pick 5. Not for lack of, ideas out there or lack of originality, but I just can't believe the opportunities out there. So a real cynic would be like, well, you can't believe it because you're an idiot and you don't know that the market's in the tank. Fine, that's one person's view. But that is based on fear, and that is based on the right now. Yes, right now, I just told you the condo market absorption rate in June was 26.5%. And I just told you that someone's trying to assign a pre-construction purchase that they paid $1,625 for. And I just told you that we're in a slow season and that listings are through the roof and all of these negative indicators. So why in the world am I telling you that now is the time to jump in and buy this condo? Because all markets recover. Someone paid $575 for this 4 years ago. You go pick it up for $475. Well, David, it sounds like you're explaining the greater fool theory. I bought for $400. I sell it to someone for $500. They're going to sell it to someone for $600, and they're going to sell it to someone for $700. Yeah, the greater fool theory. I'm familiar with it. This is not that. This is saying, then the point I made about all markets recover, I showed you 2008 took 14 months to recover to that peak. 2017 took 34 months to recover until that peak. And we're coming off of a 2022 peak. We're now 2 years past that. This market will recover. The fact that someone paid $575 for that condo, you could go pick it up for $475. If it's me, I'm an agent, well, I get to throw in the fee that I would make on that too, so it's even better for me. But the math works on it, guys. And I'm going to do this, again, if you're listening, the numbers aren't fantastic. But if you were to buy this thing right now at a variable rate, it's with 20% down, it's $2,100 a month in your mortgage. This thing rents for $2,300. Then you back out the fees every month, maintenance fees, about $440, and the $200 a month property tax. I'll save you the math, guys. You're going to be negative $500 per month on this. That's a negative cash flow. That's a bleed. Most investment advisors would say, why would you invest in something where you're losing money? Well, of your $2,100 a month mortgage payment, $500 to $600 of that, of course, is principal pay down. So you're not actually losing through the forced savings. But when rates come down, because they're going to, I looked at this thing and I said, if we get to a point where you have a 3.49% 5-year fix, that's my number. That's the number I like to work with. If you get to that point, all of a sudden, this thing is cash flow neutral, and you're paying yourself $700 a month through the principal portion of that mortgage. Okay, $700, cool, times 12 months. What's that, $8,400? Doesn't sound like a lot, but the point is you're riding the appreciation. This condo was $575. Now you're getting it for $475. A year, 2 years, 3 years, that market will come back. You're basically picking at the scab of another person in the market, right? They lost. That's fine. Every market has winners and losers. And there's nothing wrong with going and picking something up that someone else lost. In this case, someone lost 100,000 real dollars. Now, in the pre-construction world, as I said earlier, those losses will be absorbed by the original buyers who paid $1,625 a foot, which I would never sell to them in a million years. I've never sold a pre-construction condo. But there are losses out there being realized. And anytime there's a loss, there's a gain as well, because the market is a zero-sum game. If someone makes $100,000, someone else lost $100,000. And I'm talking about in this niche right here. Or if you wanted to say if someone bought for $1 million and then sold it to someone else for 1.1 a couple years later, well, that person didn't lose, the buyer. They lost the opportunity cost of having been able to purchase it earlier for less. So there's always a zero-sum game. And in what I'm talking about right now, where somebody has paid $575 and you're buying it for $475, that's a real loss they've realized that you are actually absorbing when this thing goes back up in value. When this thing goes back up in value, that's what he said, because he's telling us that everything's going to return and it's going to be great and it's going to be rosy and it's going to be perfect. I get it. It sounds salesy. And I usually don't do these pieces. I really like to do things that are more thoughtful, things that are more informational, educational, instructional, and not so much sell, sell, sell. But I'm not selling. Don't listen to me. You don't have to. I'm going to see that condo tomorrow with Tara. And you know what? Maybe I'll throw an offer in there because I love that opportunity. The rental market's soft right now. I don't care. Maybe I don't get $2,300. Maybe I get $2,200. What's the $1,200 a year difference when you're picking this thing up for $100,000 less than somebody bought it for 4 years ago? In a market where interest rates are declining because the Bank of Canada is introducing quantitative easing. In a city where there are no new launches and no new sales, which will result in a massive deficit in condos in 3 to 5 years. In a country with unemployment that's rising, which will only lead to further rate cuts as inflation continues to ease, I think I've given you enough reasons. And I actually really enjoyed doing this podcast. I got pretty charged up about it. I just think there's value. And if someone's listening and they're not interested, maybe it's because you've never done it. Maybe it's because you have the fear, like most people. You want to buy on the way back up. I get it. You want to see the market recover on the uptick and it's more comfortable. But in order to make money or the most money in any market, in any investment, there has to be a little bit more risk. And for those of you that are listening and just saying, absolutely, it's so ridiculous, it's so overpriced, these condos are going to $200,000, or all of the other things that I've been hearing basically since I started in this business, which reminds me, you should listen to my podcast. I think it was the second or third one I did, why people love being bearish on Toronto real estate. So if you're being bearish right now, listening to, the snake oil salesman try to convince people to buy condos in a down market, just listen to that podcast. You might learn a thing or two about yourself. Anyways, guys, I'm going to end it right there. I had so much fun with this. This is great. So thank you, as always, for watching on YouTube. Please throw us a like or a thumbs up or whatever they do, or maybe a comment. Please remember to like, comment, or subscribe wherever you get your podcasts. As always, thanks for watching and listening here on The Last Honest Realtor. Bye for now.